I got a question for you. How confident are you that your tax rate will actually be lower when you retire? Look, we work with retirees every single day, everyday Americans just like you. Many of them are not in a lower tax rate environment. You probably invest 40 plus hours a week, growing your business, your career, getting up every day, grinding, and you're happily donating 30% of taxes to the IRS. Now, I know you're probably thinking, I ain't happily donating anything to anybody, but you're still doing it. And how much time have you taken to try to figure out the equation, how to stop donating a third of your income to the government? That's what we're here for today. I'm Andrew Nida from Asset Management Group. If you're already saving, congrats, my friend. That's exactly what you need to do. It's a great starting point. A lot of people aren't able to save. Some people just aren't saving. But the real question isn't whether you save, it's how you save. Today, we're going to unpack where to put your money so you keep more of it today, tomorrow, and of course, hopefully forever. After all, the attempt is become financially free. And to do that, we need your money working for you harder than anybody else. I mean, that's ultimately the key. Now, let me start with just some basics. When you go to save anything, whether you're buying real estate, buying equity, stock, bonds, fixed income, REITs, the reality is when you make an investment, the government categorizes your savings in three different ways from a tax perspective. You got pre-tax, Roth, and taxable. Let me start with pre-tax because you're probably familiar with it. We're talking about traditional 401k accounts, traditional IRAs, 403bs. These contributions reduce your taxable income right now, avoiding the tax liability today. Sounds nice. They grow tax deferred. You get the compound interest on money that otherwise you'd be giving to the IRS. Huge benefit. And of course, you have to pay income tax when you take the money out. They also have this interesting rule called an RMD, required minimum distribution, meaning that you have to take the money out and the government's going to force you to do that, starting at age 73 because of the recent tax law changes in the Secure Act. Now, Roth accounts, contributions are made after tax, meaning that you take your net income after you get paid and you put it in a Roth. Now, they grow tax-free. They grow tax-free. I hope you heard that. Compound tax-free. And yes, withdrawals, well, they're tax-free as well. And the government's never going to force you to take that money out until it's inherited, at least at this point based off of present law. And then there's taxable brokerage accounts. This is investments that you make after tax money. You get paid, you go and make the investment. It's liquid, it's available. It's a joint account, an individual TOD account. You'll pay taxes on dividends and realized capital gains when you sell it. You could always be booking losses as well, creating a negative or a positive impact to your tax liability. But you also get flexibility and the ability to harvest losses. And if you have a taxable account, by all means, you should be harvesting. You just take year 2025 as an example. Massive dip at the end of Q3. We saw significant volatility in the markets, the first talk of tariffs. Did you harvest any losses? Did you book any losses? Because you should have. At this point, you could be well positive in your account, sitting with reasonable losses to offset your tax liability at the end of the year. Why not do it? Key point, 90% of the workplace retirement plans, they offer a Roth option, and many offer post-tax contributions as well. You're no longer stuck with just the old-fashioned, old-school pre-tax 401k, and contribution limits are incredible, up to $70,000+. So the reality is, this is not just a sit it and forget it plan. This is one you need to have some thought put into to make sure you're saving correctly and saving at the right level, taking advantage of these laws that are in place. The challenge you have is predicting your future tax rate. And this is really where it gets spicy. At the end of the day, the question is this: is it better for me to pay the tax today or pay it later? Meaning, to do that, you have to know what taxes you would pay later. Quick question for you. How confident are you that your tax rate will actually be lower in retirement? You know what you make today, but have you thought through what laws are in place to prevent you from being in a lower tax rate environment in retirement? Do you know that your Social Security can still be taxable? Do you know that there's IRMA limits, income-related monthly adjustment limitations, that can affect the cost of health care? Do you know that the government's going to force you to make distributions from your retirement accounts, oftentimes influencing the increased cost of health care with IRMA? Look, many people assume it's going to be lower. And yes, retirees don't pay payroll taxes and can use tax-favored streams like municipal bond interest and Roth withdrawals. But for high-income earners or many everyday Americans just like you that have saved the majority of their retirement in a pre-tax account, it can be a problem. It's true. Then there are reasons your tax rate may not drop. And for many of our clients, they don't drop, which are all a few reasons why you may need to do something about it. Let me cover just a few things here why your tax rates may not drop. Number one, progressive tax brackets. If you have retirement income in the form of pensions, Social Security, rental income, business payouts, RMDs, then those streams of income can drive your taxes higher. And that alone can keep you in a higher tax bracket. Legislation risk. Tax laws have changed. Rates could, at some point, go up in the future. And they may do that, to fund debt or social programs. The assumption that you'll be in a lower bracket just may not hold. Maybe you're close, but if tax law changes, will you be that way forever? What about phase outs and surcharges? Higher income in retirement can trigger many problems. Trigger phase outs on deductions, surcharges like Medicare IRMA. Look, there's people paying literally $400 or $500 plus just for Medicare, a benefit they pay taxes to get. Then they're paying to get it, and they're paying a surcharge because of income-related monthly adjustment. How does the government get more money from you in retirement? It's just not taxes. It's the combination of using your taxable income to charge for extra expense on benefits like Medicare. That's why I urge clients all the time, diversify the way you save to create tax-efficient buckets, create some flexibility to play the game correctly in retirement. What you don't want to do is just gamble, put some money back in your 401k, although it's a great decision, but not think about how you're doing it. I'm going to give you 4 quick questions that will at least challenge the way your framework works now and the way that you're thinking about how you're saving. Instead of focusing solely on 401ks, try using these 4 questions to build a balanced, tax-efficient savings plan. Number 1, what is your tax bracket right now? What's the top bracket that you're reaching and the rate you pay on your last money earned? And what might it be later? Simple question. If you're in a high bracket today and expect lower taxable income in retirement, pre-tax contributions can give you immediate relief. If you anticipate similar or higher tax rates later, maybe you're building a business or you expect some big liquidity event in the future. You may want to consider a Roth or a taxable account. Maybe that would be better. Use a Roth, and of course you get the growth tax-free. Now, how much flexibility do you need? Roth accounts allow tax-free qualified withdrawals, and there's no RMDs, giving you loads of control. Pre-tax accounts offer the most liquidity. You can access your money at your money. Lower your taxable income today, but lock you into future mandatory withdrawals. Pre-tax accounts lower your taxable income today. Nice touch, but they lock you into future mandatory withdrawals. Obviously could drive that tax rate up a little bit further. Are you taking full advantage of your employer benefits? Good question to ask. You should be. It's free money. You should always contribute enough to capture the full match. It's free. Nothing else in your life's going to double that money day one, right? Many plans offer reasonable match. You should be taking advantage of it. Many plans also allow you to split contributions between Roth and pre-tax contributions. Some even allow Roth-treated matches. Definitely ask your HR if it's even an option. And then lastly, can you go beyond basic limits? After-tax contributions plus in-plan conversion, aka mega backdoor Roth. Look, this can push contributions toward the total plan limit, $70,000+. This is incredible for our high income earners. You're talking about loads of money being able to flood into a position that will forever be tax-free and tax-free compound growth. You're not going to get better than that. And then of course, outside your plan, don't forget things like HSA plans, 529 plans for education, taxable accounts, which offer you flexibility so long as you're completing some tax loss harvesting. Now, rhetorical reality check. When's the last time you examined your pay stub to see how much goes to taxes versus savings? You don't have to answer the question. That's why it's rhetorical. But the reality is you probably know a little bit enough to know it just makes you mad. What if you redirected that tax bill into a tax-free bucket? What if we could show you ways how to unlock and decrease the amount you're having to give to the IRS to use that money to benefit your future? Have you spent more time planning your next vacation than considering your financial options with taxes? I could tell you story after story how just a little thought and some creativity could allow you to keep much of what you're giving away right now mindlessly to the IRS. Which tax bucket are you maxing out first? And why? Important question to ask. Use these questions, every one of them, to audit your own habits. Don't let the default payroll deduction be your only plan. Every dollar you keep, from the IRS is another dollar working for you and your family. After all, you're the one investing your time, your energy, your skill set every single day. Make sure you take time not just to give the government 30% of what you do, take time to figure out how we can use that to consistently improve your attempt to become financially free. This is just for illustration, but I'm going to give you some simple allocation framework. This is not guidance nor advice, because really it's based off of your story. There's no hard, rigid rules, but this is just something you can reference. If you expect lower rates later, meaning that you expect that you're going to go from the income you make today, and after you've researched how much you're going to pay in taxes on Social Security and your pension or whatever you have, you realize that your tax rate is in fact going to be lower. Well, consider allocating maybe 60 to 80% to your pre-taxed account. Get the deduction today. Get the compound interest on money that you would have to give the government. And then use the rest to fund the Roth, or the taxable side of your retirement account. You're trading today's deduction for tomorrow's bigger withdrawals. I'm not against that if it makes sense. If you expect similar, the same, or higher rates later, flip it. Tilt your contributions toward Roth, 60 to 80%, and keep some pre-tax for flexibility. Your after-tax dollars grow tax-free, and withdrawals won't bump you into a higher bracket. The goal is not to have just tax-free wealth or just tax-deferred taxable wealth. A combination of both gives you loads of flexibility when it comes to distributing money in retirement or executing a tax strategy. If you're unsure, diversify. Ultimately, you should just get to where you can be sure. Split contributions 50-50 if you want to. Roll the dice between pre-tax and Roth. I wouldn't. After all, it's what you work hard for every day, but at least it's something. Diversification hedges against legislative risk and income uncertainty. You need the combination. You just need to know what the next best step is for you, which is why you need to consult with a financial planner, a financial advisor, a tax advisor. Just keep in mind, the goal is not always to reduce your tax liability this year. A lot of tax advisors, that's their attempt. How do we lower your tax liability today? But what if the best thing for you to do today is to pay the tax bill? Because the benefit of the long-term value of tax-free growth is what you need. All right, final thought, and it's a wrap for me. Saving money is the easy part. Keeping it is where the game gets interesting. Don't hand over 30% of your income without a fight. Take time to understand where your dollars should live. Pre-tax, Roth, or taxable. Don't guess on your future tax rate. Build a strategy that works in multiple scenarios. At the end of the day, once again, you wake up every day, and you work hard for what you do. Make sure that you take the time to ensure that that money is going to you and your family for your future and for your goals. If this video challenged your assumptions or taught you something new, like the episode, subscribe for more high earner playbooks and strategies just like this. Our goal is to challenge the way you think, to ensure that you're doing what is necessary to accomplish your goal and that you're going in the direction that you expect to go. If you have any questions, drop them in the comments below. I read every one of them and we'll make sure we get you an answer. More importantly, stay locked in, stay focused, take care of your family, work hard, be the best you can be today, tomorrow, and in the future. We'll see you next week.